In this week's video, we'll examine the question, is it 2001, 2007 like Plunge coming soon in stocks? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. We'll be taking a little bit different angle this week, and we'll be examining some of the weaker portions of the broader stock market, including the Dow and the NYSE composite. This is the S&P 500 weekly relative to the Dow. The chart is used to make one point and one point only, that the S&P 500 has been stronger than the Dow. Similar concepts here. Now we're looking at the weekly S&P 500 relative to the broader NYSE composite. And like the Dow chart, the S&P 500 has been stronger than the broader NYSE composite. Therefore, we can surmise that the S&P 500 would score even better on a similar analysis since it's been stronger. Now we're looking at a weekly chart of the NYSE composite in isolation. The blue line is the 22-week moving average, and this is Williams %R down here that helps us better understand weekly momentum. Here you can see the 22-week moving average had a negative slope and was waving yellow flags for 7 months before really bad things started to happen in the stock market in 2001 and 2002. In this case, the market rallied back, and at this point, you're only 3% below the all-time high. So point of the exercise here, there's a yellow flag waving for 7 months, telling us that the longer-term trends are waning, and the probability of a big plunge is getting higher. In fact, from this point here to this point here, the NYSE Composite Weekly lost an additional 36%. Momentum. Overbought. That's actually bullish when you stay in there. Here, we're getting yellow flags. This is a very weak momentum move, telling us to be careful going forward. And maybe more importantly, when bad things start to happen, bearish momentum easily drops below this negative 80 level here. This is a strong bearish look, strong bearish conviction from a momentum perspective, and strong bearish conviction. The warning signs in 2007, 2008 were there. They were a little bit more subtle. Here, the stock market in early 2008 rallies for several weeks. Prior to that, for 7 months, the 22-week moving average in blue is rolling over here, waving a yellow flag. After that yellow flag was waving for 7 months, from this point here to this point here, the NYSE Composite lost an additional 56%. From a momentum perspective, bearish momentum here does not get into oversold territory. That's actually bullish, telling us that this is a weak momentum move to the downside, and the odds of a rally are higher, and stocks did indeed rally. Here, momentum clearly goes below negative 80. This is another yellow flag. The probability of bad things happening is higher with a look like this than a look like this. Get a similar concerning look, and when really bad things happen, you can see we stay below negative 80 for a long period of time and never even make an attempt to get back above negative 20, which represents overbought territory. Yellow flags, yellow flags, yellow flags before really bad things happened. How does the exact same chart with the exact same indicators look in 2015? The answer is quite a bit better. The 22-week moving average has been dropping for 1 month. Contrast that with the yellow flags that were waving for 7 months in 2000 and 2001, and 7 months in 2007 and 2008. Why is this relevant? It's telling us that the trends that we've seen recently and in the present day, those trends are stronger than they were in 2000, 2001, and late 2007 into mid-year 2008. Why is that relevant? It tells us that the probability of the next bad thing that happens being a plunge like what we saw in 2001 or 2008 is relatively low. It's not zero, but this looks like a trend that's so strong that the next thing that will happen will most likely be a correction, and then we would probably come back up and at least try to make a new high. Here, momentum does not reach oversold territory. This is a relatively weak move, and indeed we rallied. Here, similar situation. We rallied. This is not a confident bearish look yet. In fact, this is a look coming out of overbought territory and then not going into oversold territory that tells us to keep an open mind about a bullish resolution. Now, obviously, this can change, and this could morph into something that stays in oversold territory for quite some time. The point of the exercise is the evidence that we have in hand right now. If anything, this is saying be open to better than expected outcomes, and this is saying that the present day looks a lot better from a risk-reward standpoint than what we saw in 2000, 2001, and late 2007 into mid-year 2008. Remember, at the beginning of the video, we showed that the Dow has been weaker than the S&P 500. So let's look at the weaker or worst case scenario. Similar situation here. We've got a weekly chart of the Dow Jones Industrial Average. This is the 22-week moving average, 2007, 2008, and early 2009 here. Point of the exercise, for 7 months, the 22-week moving average was trending clearly down here. We get a little bit of a rally, and from this point here, after 7 months of yellow flags, the market dropped an additional 50%. Why are we not showing momentum here? Because the momentum test does not pass in the present day. Momentum does not look particularly good, and that's not surprising because in last week's video, we did say that there's a lot of damage out there, and we do need to manage risk closely. So the point of this video is not to try to paint a picture that everything is wonderful. It's not. Risks are high right now, and they need to be managed closely. Was the hard data and hard evidence helpful in terms of missing the last 33% of the decline in the post-dot-com bust bear market in the Dow? The answer is yes. In this case, the 22-week moving average in blue was trending down. Here's a point here. This red line shows you the trend, point to point. It's down. We can see this waving yellow flags for 15 months before the really bad things happened. From this point here, after the 15 months to this point here, that's a 33% drop that came after the evidence said we need to be careful. There's nothing particularly magical about the 22-week moving average. It is used in the CCM market model, but it's used here simply for illustrative purposes. How does the exact same chart look today? We've already admitted that Dow momentum is weak. What about the trends? Now we're looking at the exact same weekly chart using the exact same 22-week moving average in blue. The only difference this time is we're in calendar year 2015. The 22-week, instead of rolling over for 15 months as it did in 2000, 2001, or 7 months as it did in late 2007 into mid-2008, it's only been rolling over for 1 month. But the slope here earlier in the year It is flattening out. So we do have a trend that's weakening, but it's weakening from a much stronger starting position, telling us from a probability perspective that the next move down would most likely be a correction rather than a plunge like the one that occurred in 2001 or in the second half of 2008 during the financial crisis. How is this analysis helpful? It's helpful with patience and execution and implementation within the context of the rules. This just tells us to remain flexible. We don't make decisions based on what might happen. We need price to prove it by rallying in this direction and the slope of this 22-week to turn back up. We allocate based on the hard data that we have in hand. And the hard data that we have in hand right now includes the weak momentum that we've seen in the Dow. All this does is help with flexibility. Price and the hard data will take us in the right direction if the Dow can show some improvement. At this point, it still has work to do. Keeping clients and regular viewers up to date, this is our lower probability look. These are moving averages, one set of many moving averages used by the CCM market model. When price is below both moving averages and blue is below red and the slopes of both are down, as was the case here, it tells us that the probability of bad things happening is higher. Conversely, when price is above both moving averages, blue is above red and the slopes of both are up, it tells us that the probability of good things happening is higher. Note, bad things typically, really bad things typically don't happen until blue crosses below red, and good things typically don't happen. It's very, very difficult mathematically to go on a multi-month rally or multi-year rally without getting this bullish moving average crossover where blue goes above red. Looking at the same weekly chart with the same weekly moving averages in 2015 as of the close on Friday, August 14th, we can see the bias recently, for the most part in recent weeks, has been for blue to be below red as it still is now. This is observable evidence, observable deterioration. It's one of the reasons why we've had to scale back our exposure to growth assets, not eliminate our exposure. We just needed to get back in line with the market's current risk-reward profile. The risk-reward profile today is worse than it was here. And this is one example of that. There's numerous examples, observable examples and mathematical examples that are telling us risks are higher. In fact, if good things are going to happen in 2015, we need to see some things improve on this chart and on numerous other charts and indicators. Example, blue needs to go back above red and price needs to go back above, and the slopes of both need to turn up. We have held at 2076. Now we're using the same concepts. We're just moving out to longer duration weekly moving averages. Blue is on the bottom here. This is your low probability. Look, the slopes of all of the moving averages are down here and price is below all of them. Here, blue, the fastest moving average, is on top. The slopes of all of the moving averages are positive and price is above, telling us that the probability of good things happening is better here than it was here prior to this plunge in 2008. If we fast forward now to the close for SPY as of Friday, August 15th, we have the same mixed bag look that we've had for some time. It's not a disastrous look like this. And notice, based on the model, we don't need to anticipate what will happen. We can see this deterioration here before really bad things happen. This is late 2007, and we can see improvement here in 2009 before good things start to happen. So the way that we use this under our system is we don't anticipate which way we're going to break. We simply use the data that we have in hand now. That data is telling us that risk is higher today than it was here, and the probability of a plunge is also higher. We also know when we get these tight moving averages that we can get a big move up or down, which calls for flexibility. Since there's no magical indicator or risk-reward ratio or set of moving averages, the market model is highly diversified. This is another set of weekly moving averages here, and you can see we have observable evidence in 2008. Blue is on the bottom. This is not a good look, and you get a lower low here. How do the exact same moving averages look today? The look on Friday, August 14th, this does a good job summarizing what we have here. This isn't a disastrous look. This doesn't look anything like this period here, nor does it look anything like these tight moving averages here that tell us a big move could be coming. This does a good job summing everything up. The longer-term trends were very, very strong, telling us that the probability of a plunge like that is not particularly high, but we can also see numerous forms of observable deterioration. In this case, blue has actually dropped a little bit below red, and we've got some slopes that are down, and we're making a series of lower highs. The risk-reward ratio using these indicators is more favorable here than it is presently, and that's why our allocation to stocks can be higher here than it is here. Our allocation doesn't have to be zero, but we just dial it back a little bit to stay in line with the present day risk-reward ratio. This is a daily August 14th chart of the S&P 500 that we've shown on Twitter several times. What we'd like to see, this is still a downward sloping trend channel. In midweek here, we made a lower intraday low relative to this low and a lower intraday low relative to this low. All things being equal, that's not what we want to see. We'd prefer to see a higher high made above 21.14. The probability of good things happening will improve a little bit, and it'll be a baby step if we can clear this level. This is a different version of the August 14th S&P 500 daily. One thing to note here, notice how we have a trend channel here that's sloping up and some other trend channel lines that are sloping downward. There are always numerous trend channels and trends taking place within the fractals behind the market on different time frames. The point of saying that is, if we get locked in on one trend channel or trend line, that can be a big, big mistake. So here we did pick up a reference point this week. This is the intraday low here. This high here and this high here occurred before this intraday low. This slope here aligns with this low and this low, now telling us there's a chance that price will come back up to the top of this trend channel. We also have to respect these downward sloping lines. We'll let price sort it out. For now, we can afford to be patient with our stock-related ETFs as long as the S&P 500 can stay above last week's low of 2052 and better yet, 2044. From a risk management perspective and from an implementation perspective, you can really re-watch last week's video. Everything that we said in last week's video applies to this week with one exception. The math has actually deteriorated further. How can that be? The stock market was up this week. The longer we stay up here, the weaker and weaker and weaker the momentum gets and moving averages start to roll over. So the longer we fail to clear 2134 on the S&P 500, the higher risks become, especially when you come down here. So for example, if we only use price, risk is not the same here as it is here or here. Why? Momentum and trends are much, much stronger here, telling us that the probability of a bounce is higher. We don't have that now. Risks are much, much higher, and the math behind this market is much, much weaker, telling us that the risk-reward ratio here is not nearly as good as it was here. Price is still our guide from an implementation perspective, and if we move into this area here, the math and the rules will require us to take additional steps to reduce our exposure to growth. From a bullish perspective, we'd like to see price get into this area here, and better yet, we'd like to see it clear 2134 on a closing basis. The longer we can hold above 2134, if that happens, the better. You can see intra-week it was a mess. We went below this trend line here, below another trend line here, and actually below these two dotted trend lines, and then intraday rallied back. A market like this can be frustrating, but the key to success here is consistent implementation. Follow the discipline. Eventually, we're going to break above 2134 convincingly or break below 2039 convincingly, and we'll get potentially a big move in either direction. If we stick with our discipline, price, the hard data, and the CCM market model will get us in the right place. We'll head into next week with a flexible, unbiased, and open mind. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.